We're at right now on job growth looks fine. It's just that over the last year, job growth has been trending lower, and we wouldn't want it to keep trending any lower. Similarly, on the unemployment rate, I wouldn't take the increase entirely at face value. 70% of the increase in the number of people unemployed in July came from temporary layoffs. And there are a number of reasons that I'm a little bit less worried about the roughly 0.6 increase in the 3-month rate of unemployment than you might have been historically. One of those is we're not really seeing permanent layoffs. And if you look across the job openings and labor turnover survey, initial jobless claims, WARN notices, that's something that really holds up. In fact, the rate of permanent layoffs isn't just low, it's still about the lowest it's ever been in history. The importance of that is it reduces the risk of layoffs spiraling, of getting the sort of vicious circle of income loss leading to reduced spending, leading to more layoffs that would really threaten to move very quickly, perhaps more quickly than policymakers could handle. We're just not seeing that. The other reason that I worry a little bit less about the increase in the unemployment rate is that at least some of it seems to reflect temporary frictions in the labor market. Market. Most obviously, just job finding challenges for recent immigrants themselves, who unsurprisingly tend to be unemployed at a higher rate, and their share in the population has really increased. We think that's about 30% of the increase in the unemployment rate from the cycle low. And until those two trends kind of stop and until we see things stabilize, there are some softer spots that are worth keeping an eye on.
And as you said, you should never make too much of any one report or data point. So how does this report jibe with other economic data we've seen recently?
So in Q2, the economy grew, we think, about 2.5%. In Q3, we're tracking in about the same place. And I think this is an important point, that at some level, it would be odd and surprising if labor demand were to drop off abruptly, because overall economic activity continues to grow at a healthy pace. And if final demand for goods and services is still growing at a good pace, then you should need to add workers, not reduce the number of workers. So broadly, I think that's right. Now, there are a couple of softer spots in the activity data as well that I think investors have been focused on. In particular, last week, we got a softer ISM manufacturing report that seemed to trigger market expectations for bigger rate cuts and maybe start off some of this concern that we've seen over the last week. I would just say, if you're going to look at that, bear in mind that the survey data have now been misleadingly weak for a couple of years. And I think we have a better understanding of why that is now. People are frustrated with high inflation, and sometimes that frustration comes across as pessimism in surveys. Companies repeat back the recession gloom that they get from the press and that they hear in financial markets. And we've also speculated that after 2 years where we've just had very high economic volatility, big economic swings, now that we seem to be moving back to normal trend growth, a lot of companies report that in the surveys as kind of roughly unchanged activity. So there's clearly been a bias there for a couple of years. That's not new. I wouldn't take the survey data entirely at face value. And I would say that the hard data continue to show that the economy is growing at a good pace. Not as fast as in 2023, but in 2023, the rate of GDP growth at about 3% of job growth at 250,000 a month, those are just not sustainable numbers. Those were numbers that were propped up by the peak of the immigration boom. So it's important to distinguish between decelerating to a still healthy rate of growth and actually seeing the data weaken more substantially.
I also want to ask, we've